So, if we think back to 2022, the so-called safe part of the standard investment portfolio, the fixed income allocation that was supposed to be, your anchor in the storm, it experienced a pretty historic meltdown.
Yeah, historic is probably an understatement. It was a shock.
Right. Investors who thought they were totally insulated from risk just watched their bond portfolios drop, 10, 15, sometimes even 20%. And the question is why?
Well, because it turns out a massive portion of the investing public just fundamentally misunderstands the actual machinery of fixed income.
Yeah, we treat bonds like they're just boring stocks. Or conversely, we treat them like high-yield savings accounts. And neither of those is really accurate, right?
Not at all. And, that fundamental misunderstanding is exactly where the panic comes from. When you don't know how the engine works, every strange noise sounds like a catastrophe.
Exactly.
If you are going to rely on fixed income assets to stabilize your financial future, you have to understand the physical laws governing that market.
Which is exactly what we are dissecting for you today on this deep dive. We're pulling insights from a really foundational piece of research called The Investor's Guide to Bonds versus Bond Funds.
A great source. Really breaks it down.
It does. And we are skipping the elementary dictionary definitions today. If you're listening to this, you already know what a bond is, you know what a coupon is, and you're acting as the lender.
Right. We don't need to rehash that.
Exactly. What our mission is today, what we're really doing is tearing down the mechanics of the two primary ways you can actually deploy your capital. So the DIY approach of individual bonds and then the pooled approach of bond funds.
Yeah, because the central tension we're exploring here, it isn't just about yield. It is about friction.
Friction. I like that.
It really is. It's a question of how much capital, how much time, and honestly, how much active management you're willing to spend to achieve a really specific level of control.
Okay, so let's unpack this. Let's start with the friction of pricing. Before we get into the actual vehicles, individual versus pooled, we really need to talk about the physics of the asset itself.
Right, the underlying mechanic.
Yeah, because a bond is basically just a strict IOU. It's not about the company's product flying off the shelves. It's simply about them paying their debts on time.
Exactly.
But if you buy a bond, you're promised a fixed yield. But the actual secondary market price of that bond, it's going to fluctuate every single day based on macroeconomic forces, specifically interest rates.
Yeah, this is the inverse relationship, the price-yield seesaw. This is the absolute bedrock of bond math.
The seesaw. Yeah.
Right. When broader interest rates rise, the prices of existing bonds fall. And conversely, when rates fall, existing bond prices rise.
So let's walk through the actual math of that mechanism, because I think, people hear seesaw and they conceptually get it, but they don't really internalize how violent that swing can be.
It can be brutal, yeah.
So let's say you buy a newly issued 10-year corporate bond for $10,000.
Okay.
And it pays a 3% coupon. So you're getting $300 a year.
Simple enough.
Right. But a year later, central banks hike interest rates aggressively. Now, that exact same corporation is issuing brand new bonds that pay, say, 5%.
Right. So if we connect this to the bigger picture,
Yeah.
at that very moment, your 3% bond becomes vastly inferior merchandise.
Just immediately.
Instantly. If you try to sell your bond on the open market, no rational buyer is going to give you your full $10,000 for a 3% yield when they can just go buy a new bond paying 5%.
Makes sense. Why would they?
Exactly. The only way you can offload your bond is to discount the price. You have to drop your asking price significantly below $10,000 until the effective yield for the new buyer, factoring in that cheaper purchase price, matches the current 5% market rate.
Okay, let me play devil's advocate here, though.
Go for it.
Because if I bought that 10-year bond specifically for the 3% yield, and, I am entirely happy with that $300 a year,
Right.
why on earth should I care what the secondary market thinks my bond is worth on a random Tuesday? I'm getting my coupon, I'm getting my principal back in year 10. The daily price fluctuations just feel like theoretical noise to me.
Well, it is noise until it suddenly isn't.
What do you
The assumption that you will simply hold to maturity, it completely ignores the reality of opportunity cost.
Yeah.
And honestly, more importantly, it ignores the reality of life.
Life happens. Yeah.
Right. You might not care about the secondary market price today, but What if you face a medical emergency in year 3?
Oh, wow.
Or what if you need liquid capital for a down payment or a massive business opportunity arises? Suddenly, you are forced to step into that secondary market.
And you have no choice.
Exactly. And if you step in during a high interest rate environment, you will take a severe capital loss on the principal that you thought was, perfectly safe.
So the risk isn't just that the issuer defaults. I mean, that's obviously always a baseline risk. The immediate risk is being trapped. Your capital is basically held hostage by the prevailing interest rate.
Precisely. You are locked in.
Man, that perfectly frames the first strategy we're looking at, which is the lone wolf approach, buying individual bonds.
Yeah, the DIY route.
Right. And I want to use a specific metaphor here. Buying an individual bond is kind of like buying a bespoke, custom-tailored suit.
Okay, I like that.
Or even, let's use an elevator.
Yeah.
Getting into an elevator, you step in, the doors close, and you press a specific button, you know exactly what floor you're getting off at. That's your maturity date.
Right. It's highly predictable.
Very predictable. But if the building catches fire or you just decide you need to get off 3 floors early, you are in trouble. You're completely stuck in a box.
And getting out of that box mid-ride requires navigating a market that is really not designed for retail investors. What's fascinating here is that the bond market does not move like the stock market.
Not at all.
With equities, you click a button on your brokerage app and you are instantly matched with an active buyer at a universally visible price.
Right, super transparent.
Yeah. But the individual bond market is primarily an over-the-counter or OTC market.
Which means it's heavily reliant on dealers, right?
Yes. You are dealing with broker-dealers who act as middlemen. If you want to sell your specific corporate bond early, you have to request a bid.
Oh, man. So you're basically asking them for a favor.
Kind of. The dealer knows you're trying to exit an illiquid asset, and they have to take on the risk of holding that bond in their own inventory until they can find another buyer. So naturally, they build a massive margin of safety into their quote.
You're going to take a cut.
A huge cut. The bid-ask spread, which is, the difference between what you can sell it for and what someone else can buy it for, is notoriously wide for retail investors.
So that illiquidity premium is essentially a massive hidden tax on anyone trying to exit a trade early. And that's just the liquidity issue. The guide we're analyzing brings up an even larger barrier to this lone wolf approach, which is the actual capital requirement.
Oh, yeah. To manage risk effectively with individual bonds, you cannot just buy one, because if that single corporation defaults, your capital is totally wiped out.
Right, you need a ladder.
You need a laddered portfolio across different issuers, different sectors, and different maturity dates.
But the minimum denomination for most of these bonds is in the thousands. I mean, if you want a properly diversified portfolio of 20 or 30 individual bonds to shield yourself from default risk, you're looking at deploying tens of thousands, if not hundreds of thousands of dollars.
Just into your fixed income allocation.
Right. Plus, you now have basically a part-time job acting as a credit analyst, monitoring the health of 30 different corporate entities.
Which brings us to the inevitable breaking point. For the vast majority of investors, the capital requirement, the illiquidity, and just the sheer time required to manage an individual bond portfolio, it creates too much friction.
Way too much.
So the market naturally evolved the solution to bypass all of these hurdles.
Which is the power of the pool, bond funds. And if the individual bond is an elevator, the bond fund is an escalator.
I love that analogy.
Right. You step onto a continuously moving staircase. The stairs at the very top disappear and new stairs emerge at the bottom. You are in constant motion.
Yeah.
You get the steady upward ride of fixed income yield, but you never actually arrive at a final destination. There's no single maturity date where everything just stops and you get off.
And the mechanics of that escalator fundamentally change the accessibility of the asset class. I mean, a fund pools capital from millions of investors to buy thousands of different bonds simultaneously.
So you're buying a slice of the whole thing.
Exactly. You can access vehicles like the Vanguard Total Bond Market ETF or the iShares Core U.S. Aggregate Bond ETF. Instead of needing $50,000 to build a bond ladder, you can buy fractional shares for the price of a cup of coffee.
That's incredible. And the benefits kind of cascade from there. You get immediate, massive diversification, which heavily dilutes the risk of any single corporate default.
Right.
You get professional management handling all the credit analysis, and crucially, You get stock-like liquidity. I mean, you can sell your shares on an exchange on any given Tuesday, completely bypassing those aggressive OTC broker-dealers.
Yeah, that's a huge relief for retail investors.
Plus, for those relying on cash flow, funds typically pay out income monthly rather than the semi-annual schedule you usually get with individual bonds.
It really is a profound democratization of the market.
I hear all of that. But here's where it gets really interesting, and I have to stop you and push back on the mechanics of how this pool actually handles interest rate risk.
Okay, let's hear it.
Because this is where I see a massive structural flaw for the retail investor.
Lay it on me.
Okay, so if I'm holding a bond ETF and the Federal Reserve spikes interest rates, the net asset value, the price of the fund drops, we establish that with the seesaw.
Yep, the NAV goes down.
But a fund manager has a mandate to maintain a certain profile, right? They are constantly buying and selling bonds within that fund before they mature. So if the entire market is down because rates are up and the manager is selling older bonds to rebalance or handle redemptions, aren't they just actively locking in capital losses on my behalf?
Ah, so I see what you're saying.
Like with an individual bond, I can just grit my teeth and hold to maturity to get my principal back. With a fund, it feels like the manager is constantly selling the dips.
Well, it is a very common fear, but it ignores the actual mathematical recovery mechanism that is built into a continuously managed fund. Let's break down exactly how that escalator works when rates rise.
Okay, walk me through it.
Yes, the immediate impact of a rate hike is a drop in the fund's net asset value. The older bonds in the portfolio are suddenly worth less. You log into your brokerage account and you see a sea of red.
Right, which instantly induces panic.
Sure, but look at what happens the very next day or the next week. Bonds within that massive portfolio are constantly maturing. They hit the top of the escalator and they pay out their principal.
Okay.
Plus, new cash is also flowing into the fund from other investors.
Yeah.
So what does the fund manager do with that cash? They don't buy more of the old 3% bonds. They immediately deploy that capital into the newly issued 5% bonds.
Ah. Okay, so the yield of the entire fund begins to slowly grind upward.
Exactly. The escalator is now adding higher yielding steps. As the older, lower yielding bonds roll off, they're systematically replaced by higher yielding instruments. Over time, that higher monthly payout begins to mathematically offset the initial drop in the principal's value.
That makes total sense. It's basically a game of catch-up.
It is. If you have a bond fund with an average duration of, say, 6 years and rates spike, your portfolio value drops. But if you hold that fund for roughly that 6-year duration period, the compounding higher yield from the new bonds will have completely replenished the capital you lost in the initial price shock. Yeah, you essentially trade the absolute certainty of an individual maturity date for the automated self-healing mechanism of perpetual diversification.
That fundamentally reframes how we should look at a dropping NAV in a bond fund. It's not a permanent loss of capital, provided you have a time horizon that matches the fund's duration.
Right.
The fund is actively digesting the higher interest rates and turning them into future yield.
Exactly. But we cannot present this as a flawless utopia. Convenience is never free.
No, it never is. So what does this all mean? Let's talk about the hidden traps, starting with the friction of fees.
Ah, yes. The fees.
The guide we are pulling from warns explicitly about expense ratios. I mean, you're getting professional management, liquidity, daily rebalancing, but the fund managers obviously take a cut.
Naturally.
And while an expense ratio of, say, 0.5% sounds like a rounding error when you were talking about high-flying tech stocks, it acts completely differently in the fixed income world.
It really does. It acts as a direct, unmitigated drag on your yield. You have to evaluate fees not as a percentage of your total asset value, but as a percentage of your actual return.
Let's run those numbers, actually, because this is where investors get quietly bled dry.
Yeah, let's do the math.
Okay, if you are in a high interest rate environment and your bond fund is yielding 6%, a 0.5% expense ratio means the manager is taking about 8% of your total income.
Annoying, but, survivable.
Exactly. Annoying, but survivable. But what happens in a low-rate environment? If central banks drop rates to 0 and your bond fund is only yielding 2%, that exact same 0.5% fee means the manager is now confiscating 25% of your total yield.
Right. This raises an important question about margin compression, which is just brutal. In a low-yield environment, expense ratios act like termites in the foundation of your portfolio.
Termites. That's a great way to put it.
Yeah, you get the beautiful, professionally constructed house of a diversified fund, but the fees are silently eating away at your actual cash flow from the inside out.
Which is terrifying, honestly.
It is. This is why investors must be ruthlessly protective when selecting index funds or ETFs. You have to hunt for the absolute lowest expense ratios because in fixed income, every single basis point directly impacts your bottom line.
It really requires a profound level of self-awareness about what economic season we're in. So, to synthesize everything we've dissected today, it really comes down to a brutal honesty about your own resources and your actual behavior as an investor.
Yeah.
If you have significant capital, like we're talking tens or hundreds of thousands of dollars, if you have a very specific, defined timeline where you need guaranteed principal on an exact date, and if you are willing to manage the illiquidity of the OTC market, individual bonds are a powerful tool.
They absolutely are.
You get the elevator. You control exactly what floor you get off on.
But for the vast majority of investors, the friction is simply too high. If you want instant diversification to eliminate default risk, stock-like liquidity to exit whenever you need, and the automated self-healing mechanism of a managed duration, bond funds are the superior vehicle.
Right.
You just have to accept the perpetual motion of the escalator, endure the short-term NAV fluctuations without panicking, and, of course, guard your yield against predatory expense ratios.
It's a deliberate trade-off, control versus convenience.
It always is.
Ugh.
But I want to leave you with a final thought experiment that really builds on our discussion of the price-yield seesaw.
Ooh, I love a good thought experiment. Let's hear it.
Okay, so we spent a lot of time establishing that rising interest rates cause the market value of existing bonds to fall. I mean, the math is undeniable. But think deeply about the individual bond investor who absolutely refuses to sell early.
The ultimate buy and hold scenario.
Yes. If you hold an individual bond all the way to its maturity date, the issuer hands you your full original principal back, assuming there's no default. It does not matter if the secondary market priced your bond at a 50% discount 3 years prior. You get par value. Therefore, we really have to ask for the truly patient, iron-willed investor. Is the concept of price volatility in an individual bond simply an illusion?
Wait, really? That is a fascinating premise.
Think about it. Does the risk of a dropping price only become a real risk if your life circumstances force you to participate in the secondary market? If you just refuse to sell the asset, does the market's opinion of its value actually matter at all?
Wow. That completely divorces the concept of risk from the red and green numbers on a screen and ties it entirely to your own personal financial stability.
Exactly.
I mean, if your emergency fund is strong enough that you never have to force liquidate your bonds, the market's pricing panic is entirely irrelevant to you. The engine just keeps quietly doing its job. That is a brilliant framework to view your portfolio through and a perfect place to wrap up today's analysis. We hope this deep dive into the mechanics of fixed income helps you look at your own asset allocation with much sharper lenses. Until next time, keep questioning the mechanics.